I think it's a combination of a few things. One is you've had very strong earnings growth up till this point for the last several years, and you've obviously had higher valuations that have come along with that, which is partly a function of the earnings growth that have happened. But the other factor, which I think is what's supporting the markets to such a great degree, is the change in regime we've had in this economic cycle of very low interest rates, to an extent they're even negative in certain countries. And when you add that factor in and you look at opportunity cost of capital, surplus liquidity that provides, it does create an explainable rationale for why markets are as high as they are. We expect over the next several months and quarters the market to move more to a lower growth environment. Effectively, the underlying economies from what the equity market derives its profit from is relatively anemic. Europe has slightly recovered. The US is doing okay, but not substantially so, and China is certainly slowing. So we see those as significant headwinds to revenue growth, and because profit margins themselves are quite high, it does beg the question, where does earnings growth come from? So for that reason, we expect earnings growth to be a lot less and share price appreciation to be much harder to come by. And that also brings around an increase in volatility. So we see a handoff going from low vol, high capital returns to low negligible capital returns and high volatility. In the current market environment or price environment for oil, we see a disconnect between the equilibrium price that's needed to meet supply and demand and the current price. The time it will take to get there depends on a range of factors, but effectively it requires a tremendous amount of capital to meet the supply that's needed over time. And capital is being retracted at an unprecedented rate. The normalized price we expect to be between $70 and $80 in the medium term. And in so much as we can find companies that are being valued far below that price level, that's where we see the greatest opportunity in that space. Now, I'll tell you a little bit about Caterpillar, which is a recent addition. When we look for a company, what we're looking for are companies in good industries, well managed, good balance sheets, and good long-term prospects, as well as a good industry to be in. Now, Caterpillar is a perfect example of that. They are the largest global machinery company. They are exposed to mining, agriculture, construction, and they're geographically exposed as well. As it so happens in the current environment, almost all of those sectors and regions are actually quite weak. We don't see those as long-term sustainably weak. And because they have the free cash flow, the balance sheet to withstand this downturn, the market's valuing them on more shorter-term earnings, which we agree are going to probably be on the weaker end. But when that recovers, they are very well placed. And that's the kind of company we're looking to take advantage of. We look at financials as effectively, they're actually cyclical industries. They just have very long cycles. Sometimes that cyclicality gets missed. And they go through stages where they lend too cheaply, or undercapitalized, get into trouble, then get regulated, and that whole process reverses itself. We believe in certain segments of the financial, specifically US regionals and some of the money center banks like Barclays, Citigroup, Bank of America, they're in a very favorable part of the cycle where they're exceptionally well capitalized. Their books are in very clean shape. They've atoned for all their sins and paid for it. Yet their valuations are not reflective of that, and we see over the next couple of years there being a significant valuation readjustment as they perform through the cycle. I'll give you one example of, call it Citigroup or even UBS or Bank of America, compared to any of the top four banks in Australia. Effectively, the Australian banks, you can look at them as almost very large regional banks. They focus on providing a whole range of financial services to Australian consumers for the most part. Where if you're a global bank, call it like Citigroup, you can allocate capital. If you see opportunities in the UK, in Hong Kong, in China, in Southeast Asia, in Europe, wherever those are, you can allocate capital accordingly You can access capital from different markets more easily. So we see them more smoothly operating their businesses and less cyclical potentially over time. Notwithstanding, you can find more problems because you're in more places, and you have to find the right balance between those two things. I believe the environment that is forthcoming is perfectly aligned to what we do at Wingate. Effectively, what we do is look for high-quality businesses that are out of favor, and then we use an implementation process that benefits from increased volatility and provides a significant return through income in that process. So our process delivers most value, specifically on a relative side and also on the absolute side, when markets move lower return and high volatility. So we actually are quite excited about that prospect.